Welcome to the deep dive. If the market environment of late 2025 felt like you were trying to drink from a fire hose, 1,000 headlines but zero clarity, then you are in the right place.
Absolutely.
We are diving deep into the sources from issue number 4 of the magazine, really trying to cut through the noise to find those structural signals.
And that is the mission, always. We aren't here to just echo the financial news.
Right.
We're here to apply, the scientific method to all this chaos. We commit to the data and explain not just what happened, but how, and more importantly, why these events should shift how you think about your capital.
And we have two huge pieces of insight waiting for you. First, the cover story. It's an explosive exclusive. A special investigation from our mentor at InnoTraderFX, and it unravels something called the MicroStrategy exclusion.
This is the definitive story, really. It's all about the information asymmetry that Wall Street used to quietly manage its risk during that October crypto crash.
So we're definitely going to spend some time there, some masterclass.
It is. And second, we've launched a genuinely powerful new resource in the member area. It's the Institutional Fund Flow Analysis Dashboard.
This thing is a game changer.
It's your shortcut to seeing exactly where the smart money is moving. It tracks weekly sector fund flows, it identifies key smart money positioning, and it isolates the specific stocks driving the narrative.
Okay, let's put these tools to work. Let's jump straight into the market pulse and look at this volatility.
The last few weeks were defined by extremes.
So where should we start? Foreign exchange.
Policy divergence was the main story. I mean, the clearest example was GBP-JPY, which gained over 2%.
What was that?
Well, you had the Bank of Japan staying extremely dovish, while the Bank of England had to hold firm. That policy gap just, drives yen weakness.
Okay.
But the real shocker was USD/RUB. It surged 4.95% against the dollar.
Wow, that's a huge move.
It is. It just reflects the intense pressure from Russia's high interest rates. They're trying to support the ruble and keep inflation in check.
It really shows you that aggressive monetary policy still has the biggest punch.
For sure.
Now, if we compare that relative calm in FX to the absolute hyper-selection we saw in digital assets.
Hyperselection is the perfect word for it. The volatility was just extreme. You had altcoin breakouts like Recall surging a massive 68.5%.
But at the same time.
At the same time, completely different coins like TMI were dropping 37.4%. It's a zero-sum game right now. Capital is rushing into perceived quality and just aggressively dumping everything else.
And stocks.
On the stock side, Rolls-Royce continued its impressive run, up over 5%.
Strong defense contracts there.
Exactly. Meanwhile, Volkswagen struggled, dropping almost 6.8%, mostly from that intense EV competition.
So we have this mosaic of extremes. How did the overall market psychology hold up? For FX, the source is called the tone, cautiously optimistic. What drove that?
That optimism stemmed almost entirely from the U.S. dollar index declining 0.81%.
Okay, so a weaker dollar.
Right. It reflected shifted expectations. Traders started pricing in that the Fed would continue easing. But, we have to keep an eye on that structural differential. The 200-plus basis point gap between the Fed and the ECB is still there.
Providing fundamental support for the euro.
Exactly, regardless of these little fluctuations.
But if the FX market was cautiously optimistic, the crypto world was firmly stuck in extreme fear.
Oh, absolutely. A staggering $1 trillion loss in market cap from peak to trough.
$1 trillion.
And that figure isn't just about price, it's about structural stress. The sources highlighted two major points of strain. First, record spot Bitcoin ETF outflows. We're talking $3.48 billion. That's traditional finance selling hard.
And the second point.
Second, and this is maybe more critical, we saw the first monthly stablecoin contraction in over 2 years, a $4.54 billion net loss.
And just to remind everyone, stablecoins are like the digital cash layer of the crypto economy.
Precisely. So when that contracts, it signals a broad, aggressive risk-off positioning by almost everyone.
Wait, I have to stop you there. So we have retail selling, ETF money is exiting, the digital cash pool is shrinking. I mean, that sounds apocalyptic.
It does.
Yet, the sources noted a powerful countertrend. Institutional accumulation from major whales, even sovereign entities. How do we square that circle?
What's so fascinating here is the market split. You have the tactical players, the ETF holders, they're taking profits or getting margin called.
Right.
But the strategic players, entities like sovereign wealth funds or nations like El Salvador, They are absorbing those lows. They see low prices as a buying opportunity.
Creating a structural floor.
A structural floor for Bitcoin, exactly. Even with all the retail panic, it's a classic battle between short-term fear and long-term conviction.
Okay, so pivoting to stocks.
Yeah.
The mood was described as resilient consolidation. The year's rallies survived the wobble. Why didn't that crypto collapse drag equities down further?
Because the equity market decoupled pretty quickly. It found improved market breadth in the final week.
Meaning more stocks were participating in the rally, not just the usual mega caps.
Yes. We saw healthcare surge over 9%, showing a rotation into defensive quality. But let's pause on the structural warning. The S&P 500's forward PE ratio is still significantly elevated at 22.6x.
For our listener, why is that number 22.6x? Why is that a warning sign?
Well, because the PE ratio, how many dollars investors will pay for every dollar of future earnings, should historically be much lower, closer to 15 or 16x.
Okay.
At 22.6x, it means the market is priced for, nearly 2 years of perfect, uninterrupted growth and flawless Fed policy. It just leaves no room for error.
That sets the stage perfectly for the biggest story Wall Street tried to bury, the MicroStrategy exclusion.
Absolutely. This is where the structural integrity of the rally was challenged by pure institutional bureaucracy. We have to start with the Saylor bet.
Michael Saylor turning MicroStrategy into a Bitcoin accumulation machine.
The largest corporate one, holding 649,870 BTC, he perfected what we call the reflexive model.
Okay, let's unpack that reflexive model simply.
Think of it like this. It was an engine running on its own narrative. MSTR stock traded at a huge premium, say 1.8 times its net asset value, or MNAV.
Right.
He'd issue premium stock, use the cash to buy more Bitcoin, which increased the company's assets, which then justified a higher stock price.
Allowing him to issue more premium stock? It's a loop.
It's a loop. Every issuance added fuel back into the tank, creating value purely from the narrative itself.
And that engine requires everyone to be on the same page. The official media narrative for the October 10th crypto crash was Trump's proposed 100% Chinese tariffs.
A geopolitical scapegoat. Easy for the news cycle. But while that provided cover, the silent true catalyst was an internal MSCI consultation document published hours before the crash.
I see.
MSCI, the index provider, was defining a new 50% rule. If more than 50% of your total assets are crypto, you're suddenly classified as an investment fund, not a tech company.
And MicroStrategy was sitting at
77%.
So they were way over. Exclusion was basically a certainty.
A near certainty. So the pros who understood index mechanics realized the stock was instantly doomed hours before the public was blaming tariffs.
That is profound. And the numbers, they confirm the suspicious divergence. Bitcoin dropped 30.7%. MSTR dropped even harder, 33%.
Yes, but the real key is that MNAV collapse.
The premium.
Precisely. The market cap to net asset value collapsed from roughly 1.8x down to 1.1x. The premium, the engine, it vanished. The magic circle was broken by an index rule change.
Now, here's the uncomfortable part. The institutional play. JP Morgan waits 41 days after the MSCI document is public.
Well, after the premium disappeared,
to issue a high-profile alert, why wait?
It raises serious questions about who profited. The institutions who knew about the rule had 41 days to quietly liquidate their massive MSTR holdings at higher prices.
I see.
JP Morgan's alert, detailing the estimated $8 to $9 billion of forced mechanical sales coming by January 15th, was basically a public death notice for a company that was already gutted in the shadows.
So the big money was already out. What does this MSTR exclusion signify for Bitcoin's maturity then?
It's not an apocalypse. It actually signals maturity. Saylor was the pioneer, but now superior, more structurally sound products are here. The spot ETFs, they trade at MNAV 1.0x with low fees.
The market is normalizing.
Exactly. And the volatility tied to one leveraged corporate structure is being rightly sidelined.
Speaking of structure, let's talk sophistication. We're diving into the Q3 2025 13F filings, where the smart money reveals itself. And the key takeaway wasn't agreement, it was extreme disagreement on the mega cap AI thesis.
This is the most fascinating part of the data. You have titans making diametrically opposed bets. I mean, look at Ray Dalio. He executed a massive rotation away from AI infrastructure at any valuation. He slashed his NVIDIA position by 65%.
And where did that capital go?
Into defensive quality. Stable cash flow businesses. He increased Netflix by 900% and Verizon by 800%.
Wow.
It's a pure defensive pivot. He wants reliable income streams over speculative growth.
Yet, almost at the same time, Warren Buffett makes his first ever investment in Alphabet. A huge $4.3 billion stake.
And that's the symbolic weight, right? Buffett found value in Alphabet, a company positioned for AI, but trading at a reasonable 22x forward earnings.
So for Buffett to finally break his own mold.
It signals that true sustainable value has returned to tech and that Alphabet was the cheaper, safer bet compared to its peers.
Then you have Michael Burry, the famous contrarian, flipping to extreme bearishness.
Burry built massive positions on both NVIDIA and Palantir, but the telling detail was that he deregistered his fund.
What does that signal?
Maximum conviction. He believes a severe correction is coming, and he doesn't want external capital getting in the way during a drawdown.
And finally, David Tepper, who seems to be the most nuanced with his infrastructure over application thesis.
Tepper's betting on the picks and shovels. He's increasing NVIDIA, yes, but he's building huge stakes in the supporting semiconductor infrastructure, AMD, Qualcomm, Broadcom.
His thinking is that everyone needs chips no matter who wins the software race.
Exactly. He's betting on the foundation.
Okay, wait. So if Burry is betting against NVIDIA, Dalio is running away from it, but Tepper is doubling down on the entire supply chain. That just sounds like extreme disagreement.
It is. That's why this is a regime shift signal. Smart money is usually aligned on the macro. The capital flow map tells the story. Money is exiting peak valuation AI hype and flowing into semiconductor infrastructure, value-tilted megacaps like Alphabet, and, crucially, emerging market value. Tepper kept a huge 28.47% allocation to China.
We can't discuss capital flows without the major macroeconomic and geopolitical stress points. Domestically, the U.S. government shutdown set a record at 43 days.
And that length resulted in a permanent economic scar. The CBO estimated $11 billion was just permanently removed from GDP.
Just vanished.
Gone. And then you had the political anomaly of a private donor, Timothy Mellon, stepping in with $130 million to cover military payroll.
That raises serious institutional integrity concerns.
It does. And of course, the data blackout just paralyzed Fed decision-making.
Globally, we had a whole host of new tail risks. We saw the Saudi shock, that unilateral 1 million barrel per day cut.
That move established a clear Saudi put under oil prices. They're defending price, and by doing so, they instantly reintroduced inflationary risk back into the global economy.
Complicating the Fed's job.
Massively. They have very little control over energy costs.
We also saw Russia's vow to resume nuclear tests, which triggered the classic safety first reaction.
Of course. That kind of declaration sends capital fleeing into safe havens like gold and the Swiss franc.
And the community analysis on the Caribbean powder keg was fascinating.
It was spot on. The USS Gerald R. Ford deployment was officially counter-narcotics, but the scale suggests the real goal might be regime change. Yeah. Perhaps linked to securing Venezuela's $1.7 trillion in oil reserves.
A move to cut off China's energy supply in the region.
Potentially.
Yeah.
And finally, the Binance pardon, a key regulatory signal. It was framed as just closing the books, but the deep dive insight is that CZ's pardon was tied to a strategic partnership with a Trump family crypto venture. This signals a huge shift from punitive enforcement to, well, strategic political alliance.
Normalizing the industry for incoming capital.
Exactly.
So, putting this all together, what were the core drivers for the market movements we saw?
3 things stand out. The Bitcoin crash was fueled by Fed uncertainty, those massive ETF outflows, and breaking the $80,000 psychological level.
Okay.
Conversely, the S&P 500 surge was almost purely driven by rising optimism, that 85–90% probability of a December Fed rate cut.
Which compressed yields.
Right, and supported risk assets. And gold's rally continues to be structurally supported by geopolitics and relentless central bank buying.
Looking ahead, what are the critical December catalysts we need to prepare for?
High uncertainty around the December 9th and 10th FOMC decision. The probability of a 25 basis point cut is fluctuating around 65–70% because there is genuine division in the committee.
So the market will trade on Powell's tone.
Entirely on his tone and the dot plot. But then we have the delayed data dump on December 16th and 18th November's employment and CPI data. That will retroactively confirm or refute the Fed's decision and set the tone for January.
Before we wrap up, we saw some fantastic work in the community corner this month. The level of strategy being shared is really impressive.
It really is. We highlighted at Husem's Golden Grid, a high-sharp machine for gold, and at Tunisiano's Enicloud, nicknamed the prop firm bodyguard for its safety-first approach.
Growth and protection.
The duality of the community, and the analysis from at Enitraderfax flagging that tri-generational job security fears have hit 2008 crisis levels.
That's sobering. It's a potent leading indicator.
If that fear leads to a consumer spending snap, it validates the defensive rotation we've been tracking. And finally, the AI leadership transition is accelerating. Google's Willow chip announcement caused NVIDIA to drop 12.6%, while Google surged 13.6%.
The valuation reset is real.
It is, and the battle for infrastructure dominance is now center stage.
So let's leave the listener with a final provocative thought, tying together that MicroStrategy exclusion and the massive disagreement in the 13Fs.
Okay.
If the most sophisticated managers, the ones with the earliest information, are still disagreeing wildly, and we know the market is often rigged with this kind of asymmetric information, how much attention should you really pay to the consensus media narrative?
It forces you to ask.
Yeah.
Are you betting on a story, or are you betting on first principles, pure valuation, and the structural infrastructure needed for the next 10 years?
That's the question that matters most. If you want to dive deeper into all the detailed analysis we covered today, download our magazine for free, this issue and past issues at aswannaig.com.
The magazine is a monthly release and is available in 3 languages, English, French, and Arabic.
And remember, a monthly deep dive like this one, discussing the magazine content, is published on our YouTube channel.
If you're passionate about finance and want more rapid insights, you can also follow our TikTok channel and a Trader Hub.
And finally, if you seek a pro-grade community of traders to exchange ideas with and to learn trading in a scientific approach based on data and not on dreams and imagination,
You can visit our website, nitrader.com, to learn more about us and how you can join our community.
we'll see you next time for the next deep dive.